This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. Moody's, one of the three main credit rating agencies, recently downgraded the U.S. credit rating, marking the official end to America's top-tier credit status. This follows similar actions by Fitch in 2023 and Standard & Poor's back in 2011. This decision reflects growing concerns about America's fiscal trajectory as the national debt continues to expand. The timing is of particularly notable as Congress debates the new budget bill that could potentially impact annual deficits, highlighting the tension between revenue constraints and government spending. Over the next few minutes, we'll discuss this fiscal uncertainty and what it could mean for investors. First, as this chart shows, the federal debt has been rising over the past decade relative to GDP. It's relevant to compare debt with GDP because what matters is whether the economy can support the current level of debt. Throughout history, budget negotiations in Washington have created periods of market uncertainty. As citizens, it's natural to be concerned about our nation's fiscal path, with growing deficits and limited solutions in sight. However, when it comes to your investment, perspective matters. Over the past 15 years, we've seen multiple fiscal standoffs create volatility, from the 2011 Standard & Poor's downgrade to government shutdowns in 2018 and 2019. Yet in each case, markets eventually stabilized and recovered. Now, rather than react or trying to predict what the leaders in Washington will do, a much better approach is to follow a truly diversified investment philosophy. Being prepared for a range of outcomes is the best way to achieve financial goals, and not simply relying on hope and optimism. Hoping things will work out is simply not a plan. Next, it is likely that key provisions of the Tax Cut and Jobs Act will be extended with the tax bill currently working its way through Congress. The current proposal aims to provide economic stability by preventing a potential tax cliff where rates would suddenly revert to higher levels before this act was enacted. For individuals, the proposal would, among other things, make the 37% top tax rate permanent, increase the child tax credit to $2,500 through 2028, and potentially raise the controversial SALT deduction cap from $10,000 to $30,000. Businesses would benefit from an increased pass-through deduction, rising from 20% to 23%, reinstated the 100% bonus depreciation for qualified assets, and restored research and development tax deductions. Now, please keep in mind that this is all subject to change as the bill makes its way through the House and then through the Senate. Finally, this chart shows that despite efforts to control government spending, federal budget deficits continue to add to the national debt. The latest budget proposal includes approximately $1.6 trillion in spending cuts through changes to social programs, but these cuts could also be outweighed by tax reductions and increased spending elsewhere. This comes as our current debt already exceeds $36 trillion, equivalent to approximately $106,000 for every American. While the downgraded U.S. credit rating reflects the legitimate concerns about our long-term fiscal health, history suggests the most prudent approach for investors is to stay invested and maintain a disciplined, long-term, truly diversified financial strategy. Now, we hope you found these high-level insights helpful. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, feel free to download our eye-opening white paper titled Busting 7 Risk and Return Myths. You can click on the link below or visit our website at dynamicwg.com or emailing us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, please take care, everyone, and make smart, logical, and fact-based financial decisions.